Hey everyone, welcome back to ausbiz live from our Barangaroo studios. You've tuned in for the call over the next hour. We run through 10 stocks that you've suggested. I put them to our expert panel for their views. Let's bring them in because these two always really informative and a lot of fun as well. Shawn Hickman in the studio from Market Matters. Shawn, good to see you.
Nice to be here, David.
And Ben Clark from TMS Capital joins us online as well. Ben, how are you doing?
Very good, thanks. Sun's out, reporting season's finished, so I'm happy.
Yeah, exactly. I must admit, after the whirlwind of reporting season, sort of you're almost getting a bit bored the week or two after, isn't it? Everyone's shot their bullets and they've got nothing else to say.
Yeah, well, I think a lot of the CEOs after reporting, they then go around, you see them each morning in the city walking around. They go and see a lot of the fundies and do the sort of one-on-ones behind closed doors. And this is a period where you tend to see some weird things going on within the market, like, some stocks that are strong and some stocks that are weak. And it's normally a flow on from that. So there's still plenty to look at.
Hang on, Ben. Are you saying that these private meetings the chief executives do with selected investors can push the share price, that it's not information out in the market?
Look, I'm sure there's no price-sensitive information that we're not aware of. It might help some investors firm up a case to buy a stock or to.
Shawn, I'm a bit shocked at that.
I think you've got to be very careful what you say there, Ben. But I'm sure there's not many of the CEOs going in there say we're going to have a shocking time, sell our stock.
Right. Yeah.
So you've got to listen to what they don't say as much as what they do say.
Right. Okay. And after during reporting season, I know a lot of the chief executives that I talked to said, the market really didn't get this part of our announcement, or they treated us harshly because they didn't understand this. Are these roadshows an opportunity for the CEOs to explain more, which they think the market didn't realise?
Well, exactly. Of course it is. They can come through and say, they can't quite say, you guys missed this focus.
Yeah.
But at the end of the day, they're going to be pushing the points which they think offers the most growth and they offers positive sentiment going forward.
Interesting. All right. Let's kick it off with our stock of the day.
The stock of the day is brought to you by IG, Australia's #1 CFD provider. With over 17,000 markets and extended trading hours, turn US earnings season volatility into opportunity. Get started at IG.com.
All right, stock of the day. I thought we'd take a look at Fortescue. The iron ore price fell below $100 overnight, $96.95 US. Brings the steelmaking metal down 23% since the beginning of 2024. Now, this downturn is notably explained by the weaker demand from China off the back of that slowing economic activity. As a result, we've seen pricing pressure on Aussie mining stocks, with Fortescue down 38% since early January. Now, is this the bottom of the cycle? That all of the analysts that come on the call say, these are cyclical stocks. You don't buy them when the commodity is high. You buy them when the commodity is low. But then when the commodity is low, everyone goes, maybe it could go lower. Is it really the bottom or not? Ben Clark, is this, like everyone preaches, buy cyclicals at the bottom. And then when we get to the bottom, no one pulls the trigger because they all...
And no one knows... Are we at the bottom? I guess.
Yes, exactly.
Yeah, hindsight will tell you. I wouldn't buy Fortescue, but I would nibble away at BHP because just basically on what you said there. I think there's this growing sense of a bit of gloom around China, and everyone you speak to that's been to China recently will tell you that it's fairly grim. And we saw not just from the resource stocks, but from companies like A2 Milk and some of the other businesses that are exposed to China, that there are real pressures on the country at the moment, and on the steel price and the iron ore price as a result. Fortescue, you saw that little green circle in front of their new logo, and I'm sure that's intentional because the new management team are talking up this move into green iron ore or green steel, which Champion CIA is another big proponent of. And what these guys are looking for is ways to value add over and above what the spot price of iron ore is doing. Ultimately, what the spot price of iron ore does will dictate what the share price does. I would say it was interesting that Capital Group, one of their largest and earliest shareholders, sold out their entire stake a few weeks ago, leading into the result. It was one of the biggest block trades that's gone through the Australian market this year, and they're, I would say, very well followed. So I kind of be a hold on Fortescue if we're after a recommendation, but there are other iron ore stocks I would be looking to purchase.
Okay, all right. And just as a bit of a hint, we've got BHP came out later in the show, so we'll be more on it. But this whole buying cyclicals when they're down, it is a very brave soul that actually does that, isn't it? Because there is always this doubt. China always comes back and stimulates the economy, but will it do it this time? Is it a different sort of downturn? They usually stimulate it through property. Well, they can't do it through property anymore. They've got a massive glut. Is this the issue for iron ore?
I reckon my view would be there's one short-term issue and there's one long-term issue with China. The short-term issue is this enormous issue in the property market that they've got, and they're still trying to work out. And there's various levers potentially they could solve it with, or they could let their consumers do it tough. The longer term issue is the declining birth rate. China has a population of 1.45 billion roughly at the moment, and it's forecast at the year 2100 to be 760 million.
No.
So there's like a 780. It's so that the population is forecast to halve, and there's a lot of assets that they've built for what is going to be a much smaller population. So unless the immigration policies change, maybe it's do we see a Japan-style story there? I think there will be, but it is like it's complex. They've got to keep the people happy to a point. Otherwise, you have the risk of potentially an uprising or something like that. So hard to know, Koshi. But I think there could be a bit more pain. I mean, the other thing you just got to remember with iron ore stocks, it's not just what the iron ore price is, it's also what analysts are using as their assumptions for the iron ore price, that all the estimates that are getting fed into the broker models are coming off. And analysts have got decidedly more bearish in the last 6 months.
Yeah.
And most analysts are using spot price assumptions, which are quite a bit below the current spot price. So even if the spot price holds, ironically, you can actually see analyst upgrades into the end of the year, and you'll see a stronger share price.
Okay. Shawn?
When you talk about buying into weakness and cyclical businesses, we've talked a number of times, David, BHP, and I know I'm dressing into Fortescue here, sell 50, buy 40.
Yeah.
Okay, we did that last week.
Yeah.
BHP went below 40, market matters went up. We only went to market weight. I stress that. So we've been underweight for the last few months.
Right.
We went to market weight. We believe, to use Ben's phrase, this is the time to be nibbling around the quality end of the curve.
Right.
I don't necessarily believe that Fortescue is the quality end when we compare these two stocks.
Right.
There's a lot of moving parts with iron ore, exactly as Ben was saying. Don't forget the Chinese haven't got to worry about an election.
No.
So it's a little bit different.
That's
and, they might ban the sale of condoms, and they might push people to have more children. They've had a one-child policy. Now they can have the reverse. They can pull some levers.
They reversed that a while ago.
Oh, I know. The point I'm making is they can push.
But everyone thought they'd all go out and, hey, we can have more than one child. Well, they haven't.
No, it's a very interesting psychology. My wife is Chinese background, so I get a feel for the whole thing. I mean, when it comes to investments, the Chinese only believe in gold and property.
Yeah.
So they're not having a very good time on their property, but obviously gold's looking after them. They don't believe in shares. It's not really part of their psyche. They really, really believe, as we even know in Australia, about education.
Right.
So when they have a child, they want to give that child the best. If they have two, they want to make sure they can give those two children the best education, etc. So there are the ways that the Chinese government can do this. They can, if you have a second child, we can help you do this,
Give
and
you
help you do that.
baby bonuses.
They're going to have to do these things.
Right.
Otherwise, people will stick with one and done, and let's give that one the best education possible. Maybe send them to a overseas university. Probably not here anymore. We're sort of closing the doors, etc. A lot of moving parts. In summary, I regard Fortescue as a hold. It's not the way I'd play the space.
Right. So you wouldn't be buying in, saying this is the bottom of the iron ore cycle.
We own Fortescue in our income portfolio. I should clarify that. And if we didn't have a position, I think Fortescue will give a good yield around these prices for the next few years. Because Ben made a very, very important point as well. Is what price, not what price iron ore is today, is what price we've got built in by the analysts or their models. Right. And they're pretty pessimistic.
Yep.
Whereas I think the chap that was on before, Paul Bloxham, was talking about the fact that iron ore's gone up, it's gone down, it's gone up again, it's come down again, it's probably around the right price. If it's around the correct price, then by definition, the likes of Fortescue and BHP are probably cheap.
Right.
So, we feel that Fortescue at these levels is a very, very good yield play for the brave. I stress that, for the brave. It's not a conservative yield play.
Right.
And we like BHP to nibble into this current level.
Because they're a cheap producer, aren't they? Even at these levels, they're making good money.
Oh, they are, but they don't make as good a quality iron ore as BHP.
No.
But absolutely, they make good money. And they've now pulled their head in with the whole green energy expansion phase, even though they've put a new logo on.
Yep.
So as long as they don't get too carried away again about how they might spend to become more green in the future, because we've seen what's happened to the lithium stocks. If they stick at iron ore stays here, they do very well.
Okay, all right. Great discussion. Fortescue was our stock of the day.
The stock of the day was brought to you by IG. Turn volatility into opportunity this US earnings season with extended trading hours on over 110 key US shares. Get started at IG.com.
All right, let's cover what you want us to look at in this first half hour. Woolworths, Bega Cheese, Domain Holdings, Goodman Group and Southern Cross Media. All right, Rick wants a view, Shawn, on Woolworths, which has been pounded a bit today on the market. Yesterday it said it was going to sell the last of its stake in Endeavour, the hotel and gaming part of the business that they spun out of Woolworths a couple of years ago, held a stake in it. Now they've put it on the chopping block, and look at that share price today has taken a bit of a hammering. What do you think of Woolworths?
Well, it's down 97 cents, fully franked dividend today.
Right, so it's gone ex-dividend.
It's gone ex-dividend and a special dividend as well.
Right, okay.
So it's a pretty chunky dividend there. When their report was pretty good, they beat by 1%. And more importantly, their guidance, or not their guidance, the first 8 weeks of FY25 came in 3% ahead.
Yep.
But Coles 3.7% ahead. So again, Coles outperforming Woolworths. We think it's what I'd call a cautious buy here. We don't own it. There's nothing overly new in the space. As population grows, which is obviously going to be slowed down, that's a bit of a political football, you're going to see less growth in that area, but it's still going to grow. The population is going to grow. Good for Woolworths. I think we've seen the worst of wage rises, etc., etc. I think that's behind us. The economy is going to slow down a bit. That's not great for their big margin stuff, but it's still okay. I think it's a solid stock.
Who was it? Coles or Woolies in their earnings report said, people eating at home more rather than going out. They were seeing that flow through. I
think they both might have said that actually. Yeah. But I definitely read that myself.
Yeah.
And people are doing that. People are, they're going out once a week rather than twice a week.
Yeah.
And you're seeing that. If you want to go to a restaurant at the moment, I'm sure you like your restaurants, David. Yeah. It's not hard to get into these days.
No. So out of the two, well, let's throw in Metcash as a third one.
Yes.
Do you have a preferred?
Metcash,
right.
Yes, okay. That's our preferred of the three, definitely.
Right. Ben, first of all, Woolworths, and then I'll ask you your preferred.
So Woolies, I thought was a pretty good set of numbers. They've had a bit of a rougher trot recently, but I thought it was a good, as we were saying, Shawn was saying there, it's ahead of expectations. Probably the thing the market really cottoned onto was a better than expected start to the new financial year. Look, it's trading on 24 times this year's earnings. That feels about right to me. The company's expected to generate somewhere between 2 and 4% revenue growth each year for the next 3 years. It generates a return on equity of over 30%. There will be very few companies on the Australian share market that could say that. So it's like it's not the most exciting company, but it is a high quality business. And as Shawn said, like, I'm a big believer in talking about what's going on in China, and I think you'd be a bear on China to me because of the population story, but Australia is the exact opposite. It's one of the fastest growing Western countries in the world, and it will continue to be so even with these student cutbacks. Woolworths is a business that is very leveraged to that story. So I'll say a hold. This is a business that has given you lots of opportunities to buy on weakness. It was down near $30 not that far ago, and if it got down into the low 30s, I'd be a buyer.
Yeah. Of the three, do you have a preferred one?
Can I add another one in there? Westies?
Which one?
West Farmers.
Oh, West Farmers. Right, yeah.
Yeah, that'd be my preferred, which I would say it does look a bit more expensive than we've seen it, but I just think in that part of the market, great result from the company, and there's a lot of optionality in different parts of the business.
Yep. All right. Okay, let's go on to our second stock now, and it is Bega Cheese. Patrick wants a view on that, Ben. Bega Cheese, not only into cheese, but owns Vegemite and peanut butter. Share price up 70% in the last year. It's been a great performer, hasn't it? 18% from a week ago.
Yeah, it's been a great performer recently. It's been a pretty average performer over the last sort of 3 to 5 years, I'd say. So this business, as you said, Koshi, owns a lot of pretty high quality brands. Has a lot of dairy operations, as you expect with a cheese, but also, I think it's also one of the biggest producers of milk in Australia, and milk related products, yogurt, etc. So, look, I'm going to say sell. The valuation looks full. It's trading on 29 times this year's earnings. Now, they have done a good job after some difficult years of reinvesting into their main brands, getting away from the black and gold style brands, which the discounting really wasn't good for them. So, an improved revenue number and a much improved EBITDA number from this result, and they guided for quite a strong year ahead. So that's why we've seen this big spike in the share price. The reason I'd be a seller is just going back to the stock that we spoke about before. The thing I've learned the hard way over many years is anyone that relies on Woolworths or Coles to sell their products will never be able to over-earn for more than a short period of time, and are constantly in an arm wrestle with a partner over who gets the biggest margin. And, Woolies and Coles are the masters. If they can see someone that they believe is over-earning, they will take margin, and they're not scared of doing it. So I think this is quite a cyclical business because things like the milk price and a lot of input costs that go into their products have got better for them recently, so margins have expanded, but I'll be a seller.
Shawn?
In return to profitability, forecast was 1% ahead of EBITDA, so a slight beat to the market. I feel like the latest push-up that you mentioned was more of a relief rally than a game changer for us to go long. I wouldn't go as far as to say as a sell, although I do totally agree with what Ben's saying. I'd call it a hold. Right. There was no compelling reason for us that said, okay, you've got to get on board. This is game-changing stuff. It's just had a shocking quite a few years. There's lies, and statistics. The same thing applies to charts there. You put a 5-year chart up and it looks pretty average. Yeah. It's banked well from the lows. To me, around $5, I'd leave it alone.
So it's doubled since October.
Yep.
And as you say, look at that 2-3 years. It's just been a massive chasm, hasn't it?
And during that time, the market's gone up.
Yeah, yeah.
So that's important to overlay.
So hold, you wouldn't take profits at these levels?
If I was lucky enough to have bought down at the lows, I would be getting out at least partially.
Right,
Yep.
okay. All right, our next stock, Tom wants a view, Shawn, on Domain Holdings, the big real estate platform stock, number 2 in the market behind REA. REA, if you read what's the scuttlebutt around the market, is that it's about to do a big M&A deal. So, but look at Domain there, from $4 down to $2.83. Not the best chart for the last 12 months. What do you think of Domain?
We wrote about Domain this morning. We talked about REA, which wouldn't surprise a lot of people.
Yeah.
We all know what's going on with REA within the next 30 days. That's UK law.
Yep.
But they obviously are looking at the platform in the UK.
Yep.
Platform providers on real estate, quite simply, the number one incumbent does very well, the rest don't.
Right.
And that's true across the world. Domain is struggling big time. We would rather buy, it's a line I used today, we would rather buy an expensive REA than a cheap Domain.
Right.
Simple as that. So I would call it a hold here. You've got the major shareholders, it's again thinking what to do with its stake. It's not their focal point. I won't necessarily go as fast to say as a seller, but I think they are. So there's an overhang there potentially. I just don't see any reason to buy it.
Okay.
And the market obviously agrees, looking at the share price.
All right. So you'd be a hold if you're in it. If you're not in it, not interested.
No, I think you've sometimes got to take it on the chin. If I was silly enough to still hold it, and please, I should be careful how I word that, because some people might still be. I'd probably get out.
Right. So, but would you be a buyer at REA at these levels, even though it's in a trading hold?
No, I would rather let's see and wait and see the price they're going to pay and how they're going to do the stock play out, etc.
Yep.
But I do like the fact that they're looking to use part stock potentially to fund an expensive stock. I mean, REA is trading at the expensive range of valuations to go into a stock that's trading cheaply.
Right.
You know, so REA is up substantially this year, even after yesterday's dip.
Yep.
The UK stock was down 3.5% going into last night's 20% gap up, or 25% gap up.
Is the UK stock the number one in the UK?
Yes.
Right. Okay. So they're buying the market leader.
That's right.
Anyhow.
And what the big difference is that they don't apply the same model to what REA does. So if REA can put that model into it, then it'll be more profitable.
Yep. And
in theory.
Of course, the REA boss, Owen Wilson, says the market's still sceptical on India, and they reckon India's got to go. That's the upside. Ben, what do you think of Domain?
Completely agree. We've owned REA for many years. I wouldn't go near Domain. I'd be a seller if I owned it. And I'll give you 2 quick statistics. There are 10.8 million Australians that only use realestate.com to search for property. And there are 5.7 times more unique users on REA than there are on Domain.
Wow.
So, the history is a powerful tool in these platforms, is that there is a number one and there is daylight to second. And if number one is run well, which Owen Wilson I'd regard as one of the best CEOs on the ASX,
absolutely.
They will invest and invest and invest, and they will slowly strangle that second competitor who just can't invest at the same rate.
Yep.
So REA buy. I think this Rightmove acquisition could be a game changer for them, but it depends on how they're going to structure the financing. I'd love to see a lot of scrip and not much cash would be my only.
Right.
If there was too much cash involved, I'd be a bit more wary.
But you'd be a buyer of REA even at these levels.
Look, you probably would wait just to if you didn't own it, I'd wait to see what this transaction looked like. And just to point out, they've said they're considering a transaction. They might walk away in the next 30 days. So, there's a number of ways this could play out. But, if you look at Rightmove, it's trading on a P about half of REA's, and it looks to us like the model that they have in the UK is about 10 years behind Australia. And if REA can speed that up, there would be considerable upside potentially for them.
It is just a stupid property market in the UK. I've got a daughter who lives over there with her husband, and what they call it, the chain.
Yes.
No one can break the chain, and sort of it stuffs up everything if someone falls out. It's weird.
So another interesting one's PEXA, which signed up NatWest, which is one of, I think, the 3 largest mortgage providers in the UK. First UK customer onto the platform, and that potentially could bring the UK settlement system into the 21st century. It's just
Jeez,
it's kind of crazy that this, and we're so far ahead of them these days.
Yeah. In anything to do with financial services, they still use checks over there and all that sort of stuff. It's crazy.
Yeah, amazing.
All right, our next stock up is Goodman Group, the integrated property group, operations in 14 countries, been a darling of the market, our largest real estate investment trust, but it's more than just an investment trust, does its own development and focused on industrial, run by Greg Goodman, the founder. Ben, this has been a darling of the market for a long time. Is it still a darling in your eyes?
Yeah, we have owned Goodman for some time now, and I'd have it as a hold at the moment. I went to Goodman Group's results presentation, and I just sort of felt like Greg was just trying to cool the jets of the analysts who are getting very excited about the data center side of the business. I think it is worth remembering that, like, to me, in the industrial market, which was the only sort of part of the commercial property market that managed to escape the pain of higher rates, it feels like there now is a bit of pain starting to emerge. And the bulk of Goodman's business as at today is still very industrial focused, but it will significantly change. But I feel like he was just trying to say to the analysts, look, data centers are going to be a big part of our earnings in the future, but we're going to take our time. We're going to do this right, and we want to make sure we don't stuff this up, basically. And he spoke at length about, everyone thinks about a data center, but the complexities of actually building a data center are quite extraordinary, particularly sourcing power. We've spoken about this before, but it's even things like, to build a data center, it's got to be 4 or 5 stories, and councils typically don't have approvals for that size of building in the spaces that these are being constructed, and it's expensive and timely dealing with the council. He spoke about a data center they've just built in Madrid, where they spent 50 million euros sourcing power for that one data center. So it's going to take a bit of time, and I'd be a hold at this point.
Yeah, and that energy issue is going to get even worse. The International Energy Agency put out that data centers around the world, AI and crypto mining, uses the same electricity as Japan every year, and AI chips use 10 times more energy than a normal silicon chip, to a point where Ireland is limiting NVIDIA's importing of NVIDIA chips for fear of what it will do to the grid. So you got huge issues. Goodman, Shawn?
Great company. We actually sold out of Goodman when it spiked up at $35, $36, $37
Sure,
level.
that's like investment heresy to sell out of Goodman.
Well, and we could end up looking really silly.
Yeah.
But we don't today.
No.
And I think I agree totally with what Ben was saying, that Greg Goodman sounded like he was trying to take the fizz out of things a little bit. So they do like to, I wrote that down, taking the fizz out of it. So they do like to under promise and over deliver. Yep. So last year they guided to 9%, they've come in with 14%. So it's not unusual that they try and just play things down. But I totally think this is a great company, and I think they'll want to do things properly rather than rush it through. It's a whole new evolution of new things. So you'd
sell at these levels?
No, it's now not 32.94.
Right.
So it's already dropped 10%. It's already dropped 10%.
Pretty close.
No, but it's already dropped 10%.
Much, yeah.
Well, we're looking to re-enter anywhere $29, $30.
Oh,
it's a stock we want to own, but sometimes if you think there's a 20% swing there, it's worth nibbling on either side, a bit like with BHP.
Yep. Okay.
And we felt that Goodman had limited upside when it was 35, 36, 37, so we've sold out. took a great profit, but of course it's not great if it goes to $45.
No.
But we think there's a very, very good chance, especially after what Greg Goodman said, of getting the stock back around $30. A couple of bad days from Nvidia, we could be there.
Okay, so hold but buy around 30.
Yes.
One of my son's good mates works at Goodman, and just the way he talks about the culture of that group just is so impressive. He said, yeah, but I'll be sitting there working, and then Greg will come and sit at the spare desk next to me, and during the day just take me under his wing, sort of just explain from his experience. And I thought, he's a really good leader, and this was from one of his really young employees.
Alan Moss used to be the same at Macquarie Bank.
Yeah. No, good point. All right, next stock, the fifth one for this half hour. Peter wants a view, Shawn, on Southern Cross Media Group, the TV and radio business, owns the Hit and Triple M radio networks. I think has been looking to get out of its regional TV businesses for a while.
It's too small for Market Matters to consider. It's only a $146 million business. It's gone sideways for years. I'm sorry to be a bit short on it, but we just don't see any reason to be there.
Yep.
Right, some neutral. It's just avoid it. I'm so sorry to be so short.
No.
We just don't see any reason to be there.
No. Perfect. Ben?
Yeah, I tend to agree. I mean, that these are really tricky businesses. They have extremely high fixed cost bases, and the spending that goes through the business is it's really volatile. So they can swing from profits to losses very rapidly. It's really hard to forecast. So it's one for the traders and maybe the small cap guys. But just to give you an idea, this company generated $500 million of revenue last financial year, and $10 million of NPAT.
Right.
So it's tiny margins. And I do think an issue that these guys have got is the cost of talent. The radio announcer, your Kyle and Jackie O's, etc.
Oh, Ben, come on. Hey, whoa.
I didn't want to put any fingers. I'm sure it's a great investment.
Look at the 7 share price since I left.
So, I wasn't going to bring that up, but I couldn't help myself. But look, it's a tough business. It's very cyclical, and I wouldn't own it.
Okay. All right. Let's recap the first 5 stocks. Stock of the day. Really great discussion on Fortescue, a hold from both Ben and Shawn. Woolworths, a hold from Ben, a cautious buy from Shawn, although in that supermarket sector, Market Matters prefers Metcash. Ben prefers Wesfarmers, would you believe, in that area as well. Of course, Wesfarmers used to own Coles and spun it out, but it's Bunnings and Officeworks and the like. Bega, a sell from Ben, all out. Shawn is recommending taking profits after the big spike up in Bega shares. Domain, a sell from both. Goodman, a hold from both. Shawn, if it gets down to around $30 or under, would look at starting to get back into Goodman Group, and Southern Cross, an avoid from both. Here on the call, we've been tracking our own high conviction fund as picked by the investment committee, which Ben is part of. The latest episode of the committee meeting will be live at 2 p.m. Eastern, so about to come up, ausbiz.com in the August meeting. The committee sold Woolies, replaced it with IPD Group with a 5% weighting, also sold Soul Patts and switched into Northern Star Resources at a 5% weighting. CSL was trimmed 3% to upweight into Mineral Resources, and the portfolio up 33% since inception. All right, this half hour we're going to run the ruler on your behalf over Auckland International Airport, Lendlease Group, SRG Global, Karoon, and also BHP. All right, Ben, Ron wants a view on Auckland International Airport, the operator of New Zealand's largest airport, big infrastructure, but just doesn't lease the land, it owns the land, so it's sort of an airport and property development play as well, isn't it?
Yeah, I'm a buy. We own Auckland Airport. It's had a tough run in the last year or two due to the much higher interest rate environment, asset prices worth less, but also New Zealand coming out of COVID has been pretty bouncy. And also, you know, I was in New Zealand recently. There is a pretty full-on recession going on there at the moment. So sort of conditions are against it at the moment. But I think you've got to remember that these assets are incredibly rare. I mean, there's only 3 listed airports globally these days. We used to own Sydney Airport as well. Yeah, there's 3 listed airport groups. I think a couple of the European ones own multiples, but you know, the airports are all owned by industry, super funds and sovereign wealth funds. We used to own Sydney Airport, and I've always thought Auckland Airport is actually a higher quality asset. And the reason for that is that if you want to fly into New Zealand, there is only one gateway that you can go through, which is through Auckland internationally. If you want to fly into Australia, you can go through directly into Perth, Gold Coast, Brisbane, Melbourne, or
Adelaide.
Sydney. So Adelaide. These guys have got a monopoly. It's got a great demographics in terms of long-term travel thematic, particularly out of China, and it's out of favour. It does have a very high fixed cost base, different to Southern Cross, but you know, similar sort of theme. So they'll earn they earned 900 million in revenue last financial year. They're forecast to do about 1.3 billion in FY27.
Wow.
But their EBIT will go up by more than 50% on the back of that. And hopefully we move into a falling rate environment. So I think the setup's pretty good for AIA.
Okay, so you've got a buy on Auckland Airport. Shawn,
Yep.
Are you as optimistic?
No. Sorry, Ben, I've lost you.
Yeah.
I would just call it a hold.
Right.
It hasn't gone anywhere in 4 years. I would rather wait to see it turn the dial before I got involved.
Okay.
So I know what Ben's saying. The numbers there, they're correct, obviously.
Yeah.
But it's not yet performing. The investors don't yet like it. If it goes sideways for another 4 years in the rising market, you don't want to be there.
Yeah.
So I'd rather wait and see some of these numbers come through, some performance come through. And as
Right.
we've seen this year...
So wait for the first upgrade if you
Yeah,
like.
yeah, exactly. Happily pay more for when
Yep.
it turns the dial, because we've seen this year in Australia where we've stocks that get strong have got stronger and stronger and stronger. This isn't in that basket yet. So rather than it's not catching a falling knife. It's just rather than preempting it, I'd rather be patient.
Okay. All right. Next one, Michelle wants a view, Ben, on Lendlease Group, the big international property. Well, currently it's sort of focus got to come back more to just an Australian operation, isn't it? In the development, investment, and construction property business.
Yeah, to me, this is just a mess. I wouldn't go near Lendlease. I think there's been a number of people try and pick the time to buy this company with a view that it'll turn, but it's just kept falling. So where they're at the moment, a number of activist shareholders on the register, they're all beating their chests, wanting the company to exit all of their global operations, which management now seem to be on board of, and that's why we've seen this re-rate in the share price. So next question is going to be, what do they end up actually getting for these assets? What do they do with that money? How do they return it to shareholders? The company still has got quite a significant amount of debt. And, you know, what is left and what does the profitability of that business that is left look like? This company last year generated $10 billion in revenue and a $260 million profit. You know, like, it hasn't been good. Return on equity is like 5%. It's like less than the cost of capital. So, yeah, it goes against a lot of the things that we look for when we're buying a business.
Geez, it was an icon decades ago when sort of Dick Dusseldorp was building it and they built Australia Square. Just come a long way down, hasn't it?
Owned MLC, owned quite a Boral, I think it owned, which got spun out. So there's a lot of other business. Yeah, it's the Fairfax of the construction industry.
Oh my! Wow. All right, that'll stick, Shawn, I think. Yeah.
It was. When I used to work on the trading floor back in the 80s, it was a blue ribbon stock. Regarded there as. And it's not today.
And for youngsters who are watching and listening, that's what used to happen back in I'll say our day, they used to chalk the prices up on blackboards on the trading floor.
That's right, and shout up to them the orders, etc., etc. It was actually a lot of fun. It was a lot of fun.
A huge amount. And that space now is a gym that I go to in Bond Street in the city.
Hopefully more often than not.
Yeah. Oh, well, thanks for that, Shawn. I'll pull my stomach in now.
But seriously, it's very hard to argue with what Ben said.
Yeah.
We were one of the companies that tried to buy Lendlease thinking it was ready to turn around and lost money.
Yeah.
So I have to concur with Ben. It is still a bit of a mess. And the problem is in their May trading update, they did say that they're going to basically go beckon to what the investors want. They're going to divest, sell assets off in Europe, etc., pull out, etc., etc. What are they going to be left with when they either pay down some debt or whether they do some buybacks, etc.? They're going to be then left with kicking back up the Australian operation, which others have struggled in the space.
Yeah.
It's not necessarily a fact, come back to Australia and make lots of money. They haven't been great overseas. Why will they be great here? So I don't see any reason at the moment to try and be Houdini and pick this one.
And also, like when they get a project, it's massive, isn't it? It's huge, it's sexy, the whole thing. But if you stuff it up, the downside risk is big, isn't it?
Huge.
With the cost base, and which goes back to the quality of management, and they really haven't been able to pull it off, have they?
No, they haven't got it right. And you look at the numbers Ben quoted, $10 billion for 200 million or whatever the number was. Yeah. It's not good enough.
No.
Risk reward doesn't add up.
Yep. All right. What about this one? Vinayak wants to view Shawn on SRG Global, the engineering group, and basically in industrial services, 3,200 employees, mainly in the mining, engineering, construction, asset maintenance. So similar sort of thing to Lendlease, I suppose, in terms of a complicated operation, but I think the share price has done a fair bit better. I
would say chalk and cheese.
Right.
We're long and very bullish SRG. So they recently bought Diona. I think they paid $111 million cash and they issued some equity. And the equity they issued, they only had to issue at a 1.2% premium, discount, including the dividend to get set.
Look at that share price.
Yeah, so 1.2% discount says it all. Because normally, if you want to borrow money and issue stock to buy something, this is what we're thinking about maybe with REA, is it going to be a 5% discount or a 10% discount? The better the deal, the better the quality of the business, the lower the discount. 1.2%. It's very rare it's coming as so low as that. Yep. So this is a business that I think next year is on track to do $1.28 billion revenue, 70% of which will be reoccurring.
So this is a group that does have great management in a complex business, but they do it well.
Yeah, and margins are going from 6.1% to 6.5%.
Yeah,
it's a very, very good quality business. Okay. The share price often tells the tale. We believe it does here.
Right. So you'd be buying at these levels still?
Yes, I mean, we're long from much better levels, but absolutely we'd be buying it here.
Okay. Ben?
I'd be a bit less optimistic. Not to say, look, I've never really looked at this company, so sort of defer to Shawn on the individual, but the only thing I'd say is it's a very, very difficult industry. These guys, yes, it's good they are upgrading their margin guidance, but 6.5% margins are still pretty slim. And, I've actually got know some mates who work in this area, and it's like a Lendlease as an example, or a Goodman as an example, are trying to get these services done at the lowest rate they can. They're vital services, so don't get me wrong. Like that is, security, power, fire, all of the things that these properties potentially need, and they have to be there. But the companies want to pay as little as possible for them. And I remember Spotless, some years ago, and then Program Maintenance was another one more recently. They had periods like this where they did really well, and then ultimately it all sort of ended in tears. But look, size matters. So the acquisition looks like it's a good one for them. The bigger you are, the cheaper you can do it than your competitors, and you can take a bit of margin. But I wouldn't be getting too carried away. I'd be a hold.
Okay. It's had a really good run though. So,
It has.
if you're nervous and cautious, and you've had a great run, would you take money off the table?
Well, I definitely in a company like this, like I skim some profits along the way. If you like it, it doesn't hurt to take some profits, and if something does change, you can always look back and say I sold at great prices.
Yep. Okay. All right. Rita wants a view, Ben, on Karoon Energy. Rita says, unsure if I should hold or sell at these levels. It's the oil and gas producer and explorer in Brazil. A favourite of Maitland Thomas and Darren, who is really long on energy stocks and loves them, and this was his best oil play, but it's really come down from its peaks.
Yeah, look, it's just not an area of the market I would look at. There's so many moving parts to this business. They're operating out of the Gulf of Mexico, out of Brazil, some pretty difficult politically countries to deal in. They've just had a production downgrade and a CapEx upgrade, which is a nasty combination. The balance sheet's good. They've got no debt, so that's a tick. And then you've got like the cost outlook. You've got you've also got what they're ultimately going to be selling the product for. It's just so many ways that this could go, and I think you're throwing in a dart at a dartboard to guess where it goes next. So I want to buy something with more certainty and more levers under a company's control. So I'll say sell.
Okay. All right. So are you generally sort of bearish on the oil price going forward?
Not bearish. I just don't think I've got any ability more than the market to predict what the oil price is going to do next year, and I don't think anyone does, to be honest. There's so many factors that move it, but I'm pretty sure I know what REA's ads are going to be. Right. What the cost of putting them on their platform is going to be next year, or on car sales or on Seek. I think if you can find a business that's got as much under its own control as possible, you're setting yourself up for more chance of success.
All right, Shawn?
Wouldn't disagree with that, but I would call it a hold because of its balance sheet.
Right.
I do find some of the commodities fascinating, and I'm a bit concerned. If you're looking at the oil price, for example, you've got everything that's happening in the Middle East. It gets worse by the day, and the oil price keeps falling. So I don't see, if a market is going to, obviously we've got concerns about the global economy, but if the Middle East is blowing up like it is, and the oil price is still falling, it doesn't interest me.
Right.
I like to see a commodity or a price or a share hold or go up on bad news, not fall on good news.
Right. Okay.
Well, that's not good news, obviously, but good news, a tailwind.
Yeah.
So I don't see any reason to buy this stock, but I call it a hold, not a sell, because of its balance sheet.
Okay. But you wouldn't be interested then for the same reasons in Woodside or Santos or any of the other options here?
No, we haven't owned them all year.
Right. Okay.
And the couple of stocks that we have owned in the energy space are causing us the most grief at the moment, which is Whitehaven and Paladin.
Right. Okay.
So I don't want any more energy.
All right. Our final stock, Leon wants a view, Shawn, on BHP. Not only iron ore, but sort of copper, potash, more diversified commodities. After its recent result, Goldman Sachs upgraded its buy rating with a price target of $49. So what do you think of BHP? I'd
love it to be at $49, having bought some last week.
Yeah.
As we've said before, we recently bought some when it dipped down towards 40. I think it actually got to 38.50, but whatever, we got it around 40. I think it's a good quality, diversified miner. We all know what BHP is like. It will be very interesting how it tries to, now after the Anglo-American deal's gone quiet for a while, how it tries to take the next step in diversifying away from iron ore.
Yep.
But to me, if you're going to have exposure to commodities in Australia, it's BHP and Sandfire. Sandfire for pure copper or primarily copper, BHP more for the mix.
Okay.
And we like it, we bought it, we're long, but we're only market weight long. We're not, it's a huge part of the market now.
Yep.
So we're not overweight. I do stress that if it goes down a bit further, because it's never going to go down to $40. This is the important thing. When iron ore is going through at 120, 130,
yep,
it has to be negative news out of China
yep,
to get BHP down at 40.
Right.
You know, and I think coming back to what Ben said before, the analysts are building in lower prices for iron ore into their models, and if iron ore just stays where it is today, or just God forbid goes up, then BHP looks very cheap.
Okay. All right. So a buy for you at these levels. Same with Rio.
You've got to have a preference. We prefer BHP. A lot of analysts came out recently and said they prefer Rio. We prefer BHP. There isn't a huge between them at the end of the day, but we do prefer BHP.
Yeah. And I'll chuck in MinRes.
MinRes, we do own some MinRes, and it looks very, very cheap here, but it keeps getting cheaper.
Yeah, I know. Okay.
You bought some the other day.
No, I didn't. But,
the portfolio.
Oh yes, exactly. The investment committee last month, and since then,
was that Ben's idea?
It's dropped like a stone.
When you blame Ben.
Ben, first of all, what do you think of BHP at these levels?
Just for the record, I wasn't at that meeting, unfortunately. Came back to a very different portfolio. Anyway, BHP, I think it's an ad. I'd be chipping some money into it at these prices. It's trading on about 10 times forward on some fairly pessimistic iron ore prices, 5% fully franked yield. I think the management's done a great job. They didn't get drawn into some of those green metals that everyone went crazy not too long ago. And, I think this is a good long-term portfolio stock that you can have. And, you want to buy businesses like this when they're cheap and out of favour. And, just the other thing I'd say with the market setup this year, CommBank's now trading on 3.3 times book value. Next expensive bank globally, JP Morgan, at 2 times book value. We've seen money pour out of resources and pour into banks. It's just, we've just got this weird dichotomy in our market. And we've seen in the past, it can swing back fast and hard when you least expect it. So don't give up on those big resource stocks at the moment.
Yeah. So
a bit like the carry trade in reverse.
Yeah. $142 for Commonwealth Bank just came up on the ticker. So BHP, Ben v Rio.
I prefer BHP.
Right. And MinRes, the drop in the...
Also own some MinRes. Probably the most entertaining earnings call we listened to over the month. If you never left in doubt with Chris Ellison as to what's going on with the business. And look, it's a similar story. I think they will be able to de-gear faster than the market's expecting. They've done one very small raising in 18 years. I think there's a worry about a capital raising out there at the moment, but I think it's extremely unlikely unless you saw a much nastier iron ore price. So you're
adding to BHP. Would you be adding to MinRes?
No. When we first bought MinRes, they had no debt on their balance sheet. They've now got 4.5 billion. So, my only criticism would be Chris has pushed back very hard on analysts over the last year who have constantly brought up the quality of the balance sheet. And, I think if just as someone watching on, I think there has been, it got a bit too stretched, I think, with on coming on. And I'm sure he's got ideas as to how he de-gears, but the market's less certain.
Right.
And so it's what the believers at this point.
Okay. 12-week high of $80, and it's currently at 38.
Yeah, it's incredible. I mean, it's just a good reminder. Resource stocks, it's so hard to predict. If you went back a year, Koshi, I remember 6 or 7 of these 10 stocks would have been lithium producers or up and coming lithium producers. It was where everyone wanted to be. Green metals were the play, and no one wanted to talk about the banks or other parts of the market. Yeah. And, it's just so often you see that the narrative completely wrong-footed. And that's what we've seen. That could happen again in the next 12 months because it does tend to happen. Yep,
exactly. All right, let's recap the final 5 stocks. Auckland International Airport, buy from Ben, hold from Shawn. Lendlease, neither of them would get involved in Lendlease. SRG Global, Shawn really likes it. A buy at these levels, even with the... it's had a great year on the charts. Ben would be taking some profits on it, banking some profits but letting the rest run. Karoon a sell from Ben, a hold from Shawn, and BHP a buy from both as well. Ben Clark from TMS, thank you, mate. Good to catch up.
Thanks for having me, guys.
And Shawn Hickman from Market Matters, thanks for coming in the studio.
Thanks
always
as
great to have you aboard. That's our show for today. If you've got any stocks you'd like me to put to the expert panel so they can run their eye over them, go to ausbiz.co/callpicks or tweet us on X using the @AusbizTV handle, and of course add any comments or questions to your stocks. We love that as well. That's it for us for today. See you same time tomorrow for another edition of The Call.